Somewhere in your house, in a drawer, a folder, an email you've never opened, there's a document you've never read. It came with your pension or your ISA or that fund your advisor recommended. Nobody reads these things, and frankly, the fund industry is quite relieved that you don't. Because buried in that small print is a single number. It can't tell you which fund will top next year's table. Nothing can do that. But decades of evidence show it predicts a fund's future returns more reliably than anything else. More reliably than the fund's track record. More reliably than the fame of its manager. More reliably, remarkably, than the star ratings the industry uses to sell it. So, in this video, I'm going to put the 3 things most of us actually use to choose a fund on trial and knock them down one by one. What's left standing might surprise you, and stay with me to the end because the final number in this video is worth a very large chunk of your life savings. Let's start with the obvious candidate, past performance. It feels like common sense. A fund that's beaten the market for 5 years must be doing something right, so you buy it expecting more of the same. Here's what the data says. S&P, the people behind the S&P 500, track what happens to top-performing funds over time. They rank funds into quartiles. The top quartile is simply the best performing 25%. So take the UK equity funds that were in that top quartile over the 5 years to 2020, the cream of the crop. Where were they 5 years later at the end of 2025? Well, just 2.9% were still in the top quartile. Nearly half, 46%, had crashed all the way to the bottom. And 23% no longer existed at all. They'd been merged away or quietly wound up. That's right, a top-of-the-class UK fund was roughly 8 times more likely to be shut down over the next 5 years than to stay top of the class. You know that warning on every fund advert, past performance is no guide to future returns? We treat it as legal wallpaper. It isn't. It's the single most reliable finding in fund research. Yesterday's winners tell you almost nothing about tomorrow's. All right, you might say, funds don't persist, but surely genuine skill does. Surely the answer is to find the truly gifted manager and stick with them. Britain ran that experiment and it had a name, Neil Woodford. For years, he was the most celebrated stock picker in the country. He'd made careful savers a great deal of money, and when he launched his own funds, ordinary investors, many nearing retirement, followed him in their hundreds of thousands. Best buy lists cheered them on. Then the performance turned. Investors headed for the exit, the fund couldn't sell its holdings fast enough to pay them, and withdrawals were suspended. People who thought they could get their money out any day they liked found the door locked. Eventually, the fund was wound up altogether. Now, the lesson isn't that Woodford was a fraud or a fool. It's more uncomfortable than that. Even genuine, proven skill doesn't come with a guarantee. And by the time a manager is famous enough for you to have heard of them, their best years may already be behind them. If a track record can't predict the future, neither can the person who built it. Which leaves the professional's shortcut, fund ratings. Morningstar's star system is the most famous. Funds are graded from 1 star to 5, and 5-star funds attract money like moths to a lamp. So here's a fascinating piece of research. Morningstar's own head of research, a man called Russell Kinnell, asked a heretical question. What single piece of data predicts how a fund will perform? And he pitted his own firm's 5-star rating against the dullest number imaginable, the fund's annual fee. In America, it's called the expense ratio. Here we call it the ongoing charges figure, or OCF. It's simply what the fund takes out of your money every year, whatever happens to markets. And the fee won. In Kinnell's words, in every single time period and data point tested, low-cost funds beat high-cost funds. He went further. He pitted cheap funds with poor track records against expensive funds with great ones. The cheap laggards still came out ahead. A low fee beat a strong track record. By 2016, he was blunt about it. The expense ratio, Kinnell said, is the most proven predictor of future fund returns. Now, an honest caveat, that's American research on American funds. Nobody has run Kinnell's exact experiment on UK-only funds. But the British evidence, as you're about to see, points in exactly the same direction, and it's even less flattering. Why would something as boring as a fee beat every clever signal? A Nobel laureate, William Sharpe, explained it back in 1991, and the logic is almost embarrassingly simple. Every share is owned by someone, so before costs, the average actively managed pound earns exactly the market return. It can't do otherwise. Subtract the higher costs of active management and the average active pound must finish behind. In Sharpe's words, the average actively managed dollar must underperform the average passively managed dollar net of costs. It's not a theory, it's arithmetic. And the UK results follow the arithmetic like a shadow. S&P's latest scorecard, covering the 10 years to the end of 2025, found that almost 93% of UK equity funds underperformed the market. Only about one fund in 14 beat it. Would you take those odds anywhere else in your life? And it's actually worse than that because of what I call the graveyard problem. Over that decade, only 46% of UK funds even survived. More than half were closed or merged along the way, and their poor records vanished from the tables. The league table is flattered by the removal of its worst players, and the industry still loses. The city regulator reached the same verdict. The FCA's landmark study of the asset management industry found no clear link between what active funds charge and the returns they deliver before costs. And after costs, the more you paid, the worse you tended to do. Meanwhile, the firms taking those fees earned average profit margins of 36%, among the highest of any industry in Britain. Expensive funds aren't expensive because they're better, they're expensive because it's profitable. Let's bring this home to your own money, because the numbers involved are not small. The average UK active fund charges 0.86% a year. A mainstream index tracker, a fund that simply holds the whole market at minimal cost, typically charges between 0.05 and 0.25%. And remember, the OCF isn't the full story. It excludes the fund's own dealing costs, so the true cost of ownership is higher than the brochure number. Then the charges start stacking. You pay a platform to hold your investments. If you're advised, you pay for the advice too. As a realistic illustration, a low-cost DIY investor in a tracker might pay around 0.3% a year all in. A DIY investor in active funds around 1.3%. And the latest industry benchmarking puts the average all-in cost of investing through an advisor at 1.8% a year, 6 times the tracker investor's total. Now, 1% here or there sounds trivial. It's anything but. Take £100,000 invested for 30 years with the market growing at 7% a year. Add just 1 percentage point of extra annual charges, the gap between a cheap tracker and a typical active fund, and you end up about £172,000 worse off. That's roughly a quarter of your final pot gone. Not because markets fell, not because you picked badly, purely because of the fee. And that result barely changes whether markets return 6% or 7%. So never let anyone tell you it's only £1,000 a year. Every pound you pay in fees in year one is a pound that can never compound for you again. And it goes on costing you for decades. Here's the line I want you to remember. You can't control what markets do. The fee is the one variable you control completely, and it's the one that most reliably predicts how much of the market's return you actually keep. Now, let me be straight with you, because this channel is about evidence, not slogans, and the evidence comes with caveats. First, the cheapest fund is not automatically the best fund. A rock-bottom fund tracking only the 100 biggest UK companies and a slightly dearer fund tracking the whole world own very different things. Choosing the right index matters more than shaving off the last few hundredths of a percent. Second, for trackers, judge the tracking difference, how closely the fund actually follows its index after all costs, not just the sticker fee. Fees are the biggest driver of that gap, but they're not the only one. And third, the strongest honest case for paying more isn't that someone will beat the market for you, it's behavior. Morningstar found that over a decade, the average investor earned 6.3% a year. Morningstar found that over a decade, the average investor earned 6.3% a year, while the very funds they held returned 7.3%. That missing 1.1 percentage points came from buying high and panic selling low. A good advisor who stops you doing that can genuinely earn their fee. But notice what that is. It's the value of advice, not a reason to hold an expensive fund. Because even where active management is supposed to shine, smaller companies, the so-called inefficient corners of the market, more than 3/4 of UK funds still underperformed over the decade. So here's the claim stated carefully. No number can reliably tell you which single fund will top the table, but cost is known in advance. It comes out of your returns in every market. It compounds for decades, and it repeatedly predicts which groups of funds have the best odds. That makes it the most dependable number in fund selection. Which brings us back to that unread document in your drawer. Tonight, dig it out or download the fact sheet. Find the OCF for every fund you own. Then add the platform charge and any advice fee and look at the whole stack. And ask one pointed question. Am I paying active fees for index-hugging returns? You wouldn't be alone. The FCA found around £109 billion sitting in funds charging active prices while barely deviating from their benchmark. The fund industry has spent decades teaching us to look at everything except the one number that matters most. The great Jack Bogle, founder of Vanguard, put it better than I ever could. In investing, he said, you get precisely what you don't pay for. And if you'd really like to get to grips with evidence-based investing, you'll find hundreds of helpful videos on this YouTube channel. My book, How to Fund the Life You Want, written with Jonathan Hollow, is another good place to start. The second edition has just come out and it's full of practical, no-nonsense guidance on managing your own investments. There's a link in the description. Prefer to use a financial advisor? I think there are strong reasons to consider one. Head to the TEBI website, evidenceinvestor.com. That's evidenceinvestor.com, and click Find an Advisor. Fill in a few details and we'll help match you with someone who can guide you through it. Again, you'll find the link below. Thanks for watching.